Hello, everyone. Joe Mass here, and welcome to our third quarter market review. What we're going to cover today is we're going to talk about the past, the present, and the future. There's a lot going on. I will try to keep this as short as I can, and if you have questions, please give us a call. So there's my smiling face. I'm your Chief Investment Officer, and I'll be taking you through what's going on in the world. So on this chart here, what we see is we finally made it back. We had a crazy ride this year. Took about 23 days to go down 34%, and it took us 103 days to recover and get our money back. So the market did come back, 23 days down, 103 up, and we're back to where we started before the COVID episode this year. The other thing that people like to look at is this big drop in GDP over here on the right. You'll see that the red bar, this little red shading here represents the recession that we had, the beginning and the end. And the blue bar represents the quarterly change in GDP. So as you'll notice, the GDP was a nice ride to the bottom on an elevator there. We're down about 30%. And of course, we don't have the data in yet, but we're expecting that the third quarter results are that same V-shaped recovery and probably having one of the best quarters since World War II. So we do expect and know that GDP number will be coming back in. That was definitely some volatility that we had, right? When we saw the stock market drop, when we saw the GDP drop, what follows is the volatility. And on this chart, you can see that we've had 56 days in 2020 of a plus or minus 2% day in the market on the S&P 500. So we had 24 negative days and 18 positive days, and that's a lot of volatility. So a lot of people ask us, what does that mean for me? What are we going to do? How does that affect my portfolio? On this chart, you'll see that this is the daily price movement of the S&P 500. That's the blue bars. The white bars mark 1% up and 1% down. Okay, and so normally the market is going to trade within a 1% volatility band each day. Now you can see here that back in March and after that, these big blue bars are spiking negative 10 and up 10 range. That's the COVID spike. And you can see that volatility has definitely come down and is closer to a range of normality. So we're still expecting, about a 1% move in the market per day. So there's still going to be some volatility. The VIX is still hovering around 27. And so we've adjusted the portfolios for that, but we're definitely out of the woods from the earlier COVID episode in the year. So we'll maintain and watch that volatility, and we'll adjust the portfolios as necessary as volatility continues to unfold. Okay, stocks in the final months of an election. This is another hot topic that we're seeing right now is the election. So on the orange bars, you'll see that these are the election years, October, November, December, and the orange bars are all other years. And what you'll notice is that the return in the end of the year during an election year is very similar to all the other years. Now, this year might be a little different, but in the past, stocks have performed similarly during the final months of the election. And we'll talk about a contested election in just a moment. Now, if we look at the rest of the years, okay, so here's a chart of the S&P 500 returns over the last 10 years on a monthly basis. And you'll notice that the average 10-year return in October is about 2.29%. November's 1.63, and December's 4.8. So typically, the fourth quarter is a strong performance, shows strong performance of the market. And this year, we're going to have to see what happens in November and December, and if we have a contested election or if it goes smoothly. But this is kind of an interesting quilt to look at. Sometimes they're called quilts, return quilts, to show you what the returns have been. And typically the fourth quarter is strong. And again, in typical election years, the returns are very similar. Now, we may have a little bit of a contested return this year. That's, the scuttlebutt right now. So we should look at that data. So when we look at the last contested election here, you can see on the right, I won't read every date for you, but you can see November 7th, 2000 election day. And then on the 8th, Gore retracts his concession. And you'll see that prior to the election, the market was down 1.6%. During the contested period, it was down 5%. And a month after the contested period, the market was down 3%. So if we have a contested election we do expect there to be increased volatility in the market, and history would show that we should expect some negative returns. So we'll keep you posted on that. Another thing that we want to point out here is that coming out of a recession, value historically has performed well, where prior to the recession, growth has performed well. And so we can see here on the left-hand side of the chart, over here in the orange line, anything above the line is when growth outperformed, and the bottom of the line is when value outperformed. Okay, and so growth has definitely been outperforming. It's outperformed this year as well. But the yellow bars represent when we have large value outperformance. Okay, the next 10 years is usually a good time for value. So we're keeping our eye on that. And if you think about it, it's logical. The energy industry, the financials, they're both been suppressed. They have a lot of value in them, but they haven't performed very well this year. And so we're paying close attention to see when the tide might change. What we would do is in your portfolios is we would increase the use of the focused dividend portfolio from its current weighting of about 30%. We might get that up to more 50%. So right now we're weighted 70% growth and 30% value. Okay. Last year we were 50% value and 50% growth. In 2018 we were 100% growth. So look for us to be changing that. We're paying attention. And if we start to see value come back into play, you will see us adjust the portfolios by increasing your exposure to the value component. Okay, stock fund outflows. No surprise that during COVID, people ran for the hills. They got out of equities. And so this chart here shows that this big yellow line, that people ran for the hills and got out of equities. Now, what's interesting is that the chart on the right shows the U.S. stock performance following a year when the stock flows had major outflows. And you'll notice that after the 2008 debacle, 2009 was up 26.5. 2012 was up, after 2011, about 21%. And 16 was followed by 17 with about a 22% return. And so if the histories have any indication, that is a strong factor for equities. If we look at the evidence a little further, we'll see that in May, there was $4.8 trillion in cash or in money markets equivalents. And the chart on the right shows that the 3-year U.S. stock performance following a peak in the money supply has had great performance, 16% between 03 and 06 and 19% between 09 and 12. And the reason for that is very logical. When everyone's run for the hills and they've got out of stocks, as we saw in the chart before, and they put their assets in the money markets, they have to do something with that money at some point in time. So what are they going to do with that, right? What are you going to do with those funds? Well, what's interesting here is that the level of cash is measured by M2, the money supply. And that's the light green line here. And you'll notice that the Fed injected through the COVID, all of the stimulus that they poured onto the fire, the M2 has increased. It's a vertical line, right? So there's a lot of cash. A lot of people have more cash now than they did prior to COVID. We know there's a lot of cash. We know they got out of stocks. What are they going to do with that money? A lot of people have been talking about inflation. Well, there's only 3 things that you can do. You can either spend the money. If America spends all of this money, it will be inflationary. If people save it, and which is what they're doing right now, it's not going to be inflationary because that liquidity is going to remain in that M2 calculation, right? So it's going to stay in the bank. It's not going to be spent. Well, what else could you do with that? At some point, you want to start earning a return on your money, so you're probably going to invest that. Well, if you invest your money, you have some choices. Right now, you could stay in the bank and earn 0. You could go into bonds and earn 2%, or you could go into equities where you have at least a 2% dividend and a chance to earn 6 to 7%. And so equities, we expect to outperform the other asset classes, including international equity. And so we think that bodes well for the market, right? All of this liquidity, all this money has to go somewhere. And we expect that equities will be the place that all of that liquidity lands. Okay. So what worked last quarter? U.S. large cap growth worked. So growth worked over value. Emerging market equities worked very well when we had instability in the dollar, and that will probably continue. U.S. mid cap, small cap, and then commodities. Okay, so all of those sectors did well, or asset classes did well. In the sectors, the consumer cyclical, basic materials, technology, industrials, and consumer defense were your top 5 sectors for the quarter. And the method of investing was still focus investing over asset allocation. Asset allocation's been working very well through COVID, but with this V-shaped recovery and all the extra stimulus, equities continue to outperform asset allocation and other asset classes. What didn't work? Well, cash over the last quarter, although we saw a pullback in September, cash is not been working when the market's been continuing its upward climb. U.S. bonds, international bonds, real estate, and tips. The sectors, energy is the only negative sector, with real estate and financials right behind it. So again, those are more of your value sectors. And like we said, at some point, the value will turn around. And then the method that didn't work was being over-diversified. If we put a lot of money in everything out there, that doesn't work when we need it to be in predominantly equity and predominantly U.S. equity and emerging market and a little bit of international equity. What portfolio adjustments did we make? We increased cash amongst most of the portfolios except for the dividend portfolio. And so in late May, 5/28, we had approximately 10% cash. In August, late August, we increased that to 20% cash. And then early September, we increased that to 30% cash. We also rebalanced and rotated during the last quarter. And so the chart here, you'll see that we were able to raise cash ahead of time before the market dropped. So that was good. We increased cash here on 8/27. And so that helped us protect us against this initial slide here. Okay. And then the market peaked again on September 9th. We got kind of lucky there. We increased our cash on that update to 30%. And then that really helped as the market continued down to its lows of 9.6% down for the quarter. So our cash and our rotations worked well. Our portfolios are holding up well, and we're very happy with their performance. Of course, we will continue to recalibrate and adjust the portfolios as new data comes in, and definitely as we get closer to the election, but we are positioned in anticipation of some volatility to come. So what else will come in 2020? Who knows? No one knows. I don't know what's going to happen with the election. But we do believe that inflation is going to remain low. We still expect unemployment to remain high. And all the fiscal stimulus should help on the short term. So that should help support the markets. Additionally, monetary policy should be supportive and accommodative there. The economy's been very, very resilient, unbelievably so. It's a V-shaped recovery. Remember earlier in the year, we were talking about what shape would this be, an L, a W, a V, a U. So we did get a V shape, and we expect that to continue. Now, with the elections, anything goes. We don't know what's going to happen. Earlier in the year, we weren't as worried as we are now. Biden has decided that he's going to be pretty aggressive on taxes and regulation, or at least that's his campaign rhetoric, and that's fine. A lot of times politicians will have a lot of rhetoric, and then when they get elected, they'll back off a little bit, move to the middle, become a little more moderate. But the market right now is concerned with the capital gains going away, the DSTs going away. Some of the policies putting forth would not be very pro-business. So if Biden wins, we would expect the markets to pull back pretty severely on the short-term basis, but not long-term. We would expect the companies to be resilient. We'd expect the companies to reinvent themselves. And companies go on doing business regardless of who's president. So although it might matter between now and the end of the year, long-term, we don't expect that the market would be in a systemic a bear market. So we do think there's some risk short-term from the elections, but we would expect that to probably pull back, within maybe 18 months or so. COVID, who knows what's going to go on with COVID again? I think hopefully you're all staying safe and doing well. I think with COVID, it's not an uncertainty anymore, and so we've got a better handle on it. So I don't think we'll shut the economy down. So I think further outbreaks of COVID will not see the adverse severity in the economic impact that we saw when it was unexpected earlier this year. Most of you have heard me say this a million times, and I'll continue to say it. There's only a few things that drive equity prices. It's interest rates, inflation, earnings, the Fed's position. And so interest rates, you'll see the green line here in this top chart, are positive, that we have a positively sloped yield curve. Although rates are low, they're positive. The bottom chart shows the 10-year Treasury rate. That's the blue line. And the white line is the Fed's expectation of rates, long-term projection. Long-term meaning starting after 2023. And that's about 2.5%. So we're not expecting rates to go up anytime soon. When it comes to inflation, the red line is the Fed's target for inflation. The white line is the University of Michigan's 5-year inflation outlook. And the orange line is inflation measured by the PCE. And that's about 1.4%. So again, inflation has a little ways to come up. But based on the survey, 2.7% will not kill the stock market. And again, like we talked about a few slides ago, depending on where that money goes, if that money is spent, we could see inflation speed up. If it's invested, inflation probably will not rise very far. So unemployment's interesting. The blue line represents the unemployment. You can see the spike earlier in this year on the blue line, and then it's come down very nicely as the economy started to recover. I think what's more interesting is the labor force participation rate on the green line. You'll see that before COVID, there was a lot of people participating, looking for jobs. But you notice that the green line has not recovered. So there's about half of the people looking for jobs that there were pre-COVID. So unemployment has come down, but a lot of people have a lot of stimulus money. They're in a better cash position than they were prior to COVID. And so they're not incentivized to look for work. And so we just don't have as many people participating. That will go up, but right now it's going to stay low. Okay, earnings. Earnings are the green line on this chart. The white line represents the S&P 500. And it's been an earnings show for the last 10 years. This hasn't been a stimulus show. The stimulus hasn't been what's driving the market. It's really been the earnings. Now, having an accommodative Fed has been helpful. It's kept rates low. It's helped consumers, not savers, and not those of you who are retired and need that fixed income. But we continue to believe that the earnings will drive the equity market. So we did have a pullback. We expect our earnings to be, about $130 to $133 a share next year within the next 12 months. So they will come up, and it will take probably 2 or 3 years for earnings to recover pre-COVID. So it has been the earnings that have been driving the market. They will continue to drive the market, and they have been coming back and recovering very well outside of COVID. Now, another thing to remember here is that we like to invest. We like to invest in 5 to 20 stocks. And so we can be very selective with what we pick. We can pick the stocks that are having increasing earnings, right? Not everyone going through COVID was a loser. There were a lot of winners. And so we've been able to position into those large cap tech and other companies that were going to do well during the COVID recovery. And that's helped us out a lot. And so we can continue to do that. Now, when we look at the valuation of the market, we know that the valuation is high at the index level, right? On average, the PE ratio, which is a crude measure of value for the market, hovers around 18 in the last 5 years. And you can see that both the forward expected price earnings ratio and the current price of the S&P 500 are way in excess of that 5-year average. So the valuations are rich, okay? PEs are high. But again, we will try to select the companies that will continue to do well and that are fairly valued. That leads to where should the S&P 500 be in the next 12 months? Well, the green line is the consensus estimate of where the market will end. And that is about 37.59. We're currently at 35.11. Therefore, that gives us about a 7% increase over the next 12 months. That's about a market average. It's a long-term historical average. And so that number is believable. Okay, we could see that happening. that's where we expect the market to be. Now, with that said, the 5-year outlook for the U.S. large cap equities is about 6.4%. You'll see that a global 60% equity, 40% bond portfolio is right around 5%. And in bonds, the U.S. aggregate bonds are at 0.5%. The bond yields are very expected to be very low. So that's kind of what we're expecting over the next 5 years. And with that, it really leads us to a neutral stance. We could be bullish, we could be bearish, or we could be neutral. Right now, across U.S. equities, international equities, emerging market, fixed income, and U.S. real estate, we're neutral. In U.S. equities, we would like to be a little more bullish, except the election's in our way. So we will probably upgrade our stance and our views after the election. But right now, we're cautiously optimistic. We do believe that international equities will continue to perform well and maybe outperform the U.S. a little bit. So we're almost bullish on international equities, but again, with the COVID and the geopolitical issues out there, we're not raging bulls yet. Emerging markets again should be favorable, and if the dollar weakens, we should see some spreads in emerging markets and international equities over U.S. equities. U.S. fixed income. The reason we're not bearish on U.S. fixed income is we don't believe rates are going to go up for another couple of years. So although we're at zero, and although when interest rates rise, bond prices go down, and we're at the beginning of, or at just about at the beginning of a bond bear market, bonds have performed very well this year and have really held up some of our portfolios. So we're not ready to go raging bear on the fixed income space yet. And so for those reasons, we're neutral. On the U.S. real estate, there is a shortage. Real estate's held up pretty well, but we are at the end of a cycle. Rates are low, so that's good. People are cautious and they're waiting to see. So the markets are cooling off a little bit, and we are late cycle. So again, we are neutral. So with that, we thank you so much for taking the time to watch our little video here. We'll keep you posted. We'll do a couple more before now in the election and after the election. But we've been adjusting portfolios. We're happy with the performance of our portfolios. If you have any questions or you need to adjust your portfolio specifically, please call in, and we will go ahead and take care of that for you. So again, thank you so much. I hope this has been helpful. We really appreciate you. Stay safe, stay healthy, and I guess go vote. So anyway, thank you so much.